Namaste, Sat Sri Akal and Adab. Welcome back to One-on-One with Mr. Bond in conversation with, once again, Niket Shah, but donning a different fund manager's hat. We have interviewed him for Mid-Cap Fund of Motilal Oswal, the star fund manager of Mid-Cap Fund. He has taken over managing Flexicap Fund of Motilal Oswal about a year back, and the performance thereafter has improved dramatically. There were performance lags also in between, and we will discuss that. What were the reasons for that, and what has he done differently now, or what has he changed in his style of managing the portfolio again, that has brought back the limelight into the Flexicap of Motilal Oswal. Welcome, Niket, to the show.
Thank you so much. Pleasure to be on the show.
So remember, we had discussed in April about mid-cap fund of yours, and that continues to be a star performing fund also. And we had asked you this question, that as to what are you going to do differently so that the performance continues to remain, because generally we see that first 3 years are good, and then the balance 3 years thereafter, somehow or the other, either the sectors are not performing or stocks are not performing. So something similar happened with your Flexicap fund. But before we get into your Flexicap fund, let's revisit our global macros, because as you know and I know, we are not insulated, isolated or decoupled from the global macros currently. And of course, now the geopolitical issues are also taking the limelight and the center stage. So if you understand and if you've seen this global macro factors, in April 2023, when we had discussed, 10-year was at somewhere around 4.3% or so, and currently after touching a high of 4.8%, it's currently at 4.65%. Dollar index was about 102, 103, now currently at about 106 or so. So all these are the macros. The inverted yield curve continues to remain. The US trade deficit is almost 33 trillion, and it's added about $500 billion in last 3 weeks itself in terms of the interest rate burden which it has to carry forward. So the macros have not improved from then to now. So what do you see, and where do you see, and how do you read these global macros? At the same time, what will be the impact on the Indian context?
So I think, Sunil, as you rightly said, between last April conversation that we had versus now, I think the macro has only worsened. So I think let's look at US to start with. I think the Fed has really called out that the interest rates will remain at elevated levels for a longer period of time, which has obviously resulted in dollar index moving up from 103 to 106 levels. That is clearly risk aversion as far as currencies are concerned. But I think my fundamental problem is that I believe this cycle, the problem is not in the household or the corporate side. This cycle, the problem is actually at the sovereign side, which is the government side, right? So government debt continues to go up. This is primarily due to higher deficit that they run. Also, if you look at what happened in the last 3-4 years, virtually, if you look at between pre-COVID and now, you would see that household debt has actually come off a bit. It's almost at close to 75% of GDP versus 100% of GDP earlier. If you look at corporate debt has actually not gone anything material either side, not reduced, not gone up materially. But the government debt has moved up. So the entire baggage of the COVID has been taken by the US government, right? And by, for whatever reasons they've done in terms of printing and so on and so forth. Now, what has also happened is that if you look at from a deficit standpoint, we are broadly at about 7.5-8% fiscal deficit, which means that they will keep adding, higher and higher debt every year. But at the same time, right, which means that they have to supply more paper. At the same time, the Fed is also doing QT, right, which is quantitative tightening. Now, both of them is actually doing quantitative tightening together. Both of them are actually resulted in yields moving up higher. Now, if anything had to go wrong globally, historically, what used to happen that Fed used to print and the issue used to kind of get sorted out over a period of time.
Right.
There is no option today. If anything goes wrong, they can do further more printing, because that will only means yields will move up even much more higher from current levels.
Correct.
So I think this is a problem which is not created by, Federal Reserve or by US government yesterday. It is actually created over a period of last few years, which is now coming to haunt them in a meaningful fashion. So I would be extremely worried about this because if you look at the biggest buyers of the US bonds are either the Fed themselves, second is the China government, different governments globally, and third is private guys, right? Which is insurance
So
and so on.
China is, I
Money.
think, selling the US treasuries.
Exactly. So China is not firing up. US, the Fed itself is actually selling, right? By doing quantitative tightening. And then, the last part of it is the larger money market participants, right? They can't take such a large amount of, supply. So our view is that rates will remain elevated on 10-year. It can only get worsened from year on. So I think it's going to be next 6-9 months are going to be extremely crucial for global markets because if rates continue to remain elevated, it will have impact on, it will have cascading impact on different parts of the economy, right? You look
And
at credit
especially the
cards.
emerging markets outflows.
Absolutely, because there will be a time where if rates really, because these rates have never been seen in a long period
Since
of time. If
2007, I think you've not seen these kind
correct,
of rates since 2007.
absolutely, and if you look at from a debt to GDP standpoint, right, it's almost US is now almost at close to 125% debt to GDP, which is after Second World War. So I think these are some of the data which are literally scarier to me. And I would be extremely worried about this as we get into next year. And how this really plans out to be extremely interesting for global markets. My view is that if anything goes wrong, what will happen is you will see a lot of flight out of equities into the fixed deposit, right? So, for example,
Correct.
rate goes to 6% or 7%. People will go to US bond market and kind of hide there because 7% for a longer duration period of time is an extremely good risk reward ratios, which is extremely risk free return as such. So you will see some meltdown in equities if rates really go above 5%.
So, the $1 trillion of credit card debt, the default rates which are going up there, 8% in the mortgage rates, and bankruptcies which are happening across the US as well as in the Chinese markets also. So there's a global meltdown, and I don't think India can be isolated, insulated, or decoupled from what is happening around the world, including this recent Hamas and Israel war, along with the Ukraine and Russia war. So it will have an impact on the crude oil prices also, which is going to be impacting the Indian context also in terms of the trade deficit, the current account deficit, the rupee depreciating, the imported inflation. So all that will have negative impact in the Indian context also. So your thoughts on that, on the Indian markets now?
So I think two things you highlighted. So one is I think on the mortgage side, right? So if you look at almost 70% of household debt in US is mortgage, right? But what we have seen is household debt to GDP is come up. So I don't see mortgage default or a kind of a subprime crisis coming and haunting back us again, right? Although the savings rate in US has kind of come down materially, it's I think closer to 3%, which means that consumer in US or household in US have dipped into savings to pay back debt. But at least for now, it appears that the household side, whether it is mortgage, doesn't look like an area of concern. Yes, on credit card, there is obviously some concern. The smaller banks have started to see delinquencies going up meaningfully, and that's an area of concern. We have seen some moratorium which was given for student loans expiring in the first week of October. This was a 3-year moratorium given to them. So I think how that really plans out is going to be interesting over the next 1 or 2 years. So I think given that backdrop, and given the way how valuations have really moved up in India, right, I would be extremely cautious on equity markets for the next at least.
Even including the Indian context.
Absolutely, including the Indian context, I would be very very cautious on Indian markets for the next 6 to 9 months.
Sure. So now let's come back to this FlexiCap. So let me explain to the viewers what is FlexiCap as per SEBI definition. So in the large cap is the top 100 companies in terms of market capitalization. Mid cap is 101st to 250th company, and small cap is 251st company. But according to SEBI recategorization, a FlexiCap scheme is free to invest across market spectrum. Minimum, of course, has to be 65% in equity for it to be called an equity taxation. So this is what a FlexiCap is, and this is how Motilal Oswal FlexiCap performed in their first few years of operation. So 2014 was the inception of FlexiCap of Motilal Oswal. They were number one performer till 2017. You started with a bag, Niket, and what worked for you, I think, was some of the sectors which you had invested in. That time, I think you were overweight on financials, you were overweight on auto, and you were overweight on pharmaceuticals also from 2014 to 17. Was that the reason why it worked for you, or was there any other
Absolutely.
reason?
No, I think
Just that you got lucky and the markets were doing well at that point in time,
no.
also simultaneously.
Yeah, we were. You don't get lucky for 3 years at a time, but yeah, I think uh, there is two things which happened. One is the sector selection was spot on, and within the sector selection, the stock selection was even more spot on. We virtually got all possible multi-baggers in those 3 year duration, right? Whether it is auto, whether it is Maruti, Eicher, we were the first ones, I think, much more earlier in the game, and we made it very, very large in some of these names that we kind of talked about. I think that has given us that benefit in the first 3 years, right? So when you get the right sector within the right sector, right stocks, and you kind of hold on over the longer term, you I think tend to get disproportionate benefit of it. And some
Correct.
of these names like the likes of Eicher or for that matter Maruti or for that matter Britannia in those early days, they were just at an inflection point, right? And they became 5x, 6x from our cost price from the time that we
Wow.
bought,
Okay.
and that really gave that big fillip to the fund
Right.
at that point of time.
So, but after that, from 2018 to 2022, so this was like a, pre-COVID and during COVID and then post-COVID also. All of a sudden, I think the fund lost its steam somewhere midway. From number one performer, you became number 20 in terms of the ranking on a point-to-point basis from 2018 to 22. What did not work for you, I think, was you were still overweight on financials, you were still overweight on auto, and you were still overweight on maybe pharmaceuticals. But pharmaceuticals did well during COVID period, but naturally auto and financials would not have done so well during that period. So was that the overweight on auto and financial dragged your performance? Was your buy right sit tight policy actually drag you down?
So I think you're absolutely correct. I think while in the first 3 years from 14 to 17, we did very well because of our stock selection, and this all those stocks did very well for us. I think, as I said earlier in our April conversation, selling is extremely important, right? I think a lot of people do focus on buying, and selling is something that is not being focused so much and is extremely underrated. I think we didn't sell some of our winners at the right time, right? Whether it is Maruti, Eicher, or the multiple names, but we didn't sell our winners, and hence I think it was very, very clear that if you got a right stock, yes, we have to hold for the longer term, but we don't have to hold till eternity, right? And I think that is a philosophical change that we've
But
now
when the
done.
macros changed during COVID, were you not supposed to change your sectors and your stocks also simultaneously?
We did change, but we didn't change anything materially because it was very difficult at that point of time to make any conclusion in terms of which sectors or stocks would do very well. The
Correct.
second thing which also impacted us is the mix. So during the COVID period, given the way environment was, we decided to move towards large cap. And hence, if you look at from the bottom till now, I think it is all and out being a mid cap party, right? So the large caps really haven't fired up in a meaningful fashion. So like
Right.
while in the mid cap fund we went overweight on the mid cap IT side, and the large cap we went overweight on the large cap IT side, and large cap didn't do so well the way mid cap IT did very well in the last 2 3 years, right? So I think that's been a bit of a difference if you ask me over the last 1 or 2 years, specifically in the duration of 17 to 21 that you talked about. That first, not capitalizing on your winners, not taking that money home and moving to the next sector, next stocks. That part of it we didn't do well. And the second important thing is that while these stocks became extremely expensive, we didn't move out of them, right? So while the valuation of some of these names became expensive, we still thought that hey, they are great compounders, nothing can go wrong in them. Eicher margins moved from low double digits to 33%, and it was appearing like this will go to close to 40%, right? But this 33 actually came down back to 20s, right? Low 20s, right? So I think it's very important to book profits when the valuation becomes expensive for any names in your portfolio. Take some money home, move to the next sector, within the next sector, next stocks. While you continue to think about longer term, you also have to be very mindful of business cycles. Every sector goes through its cycles. No sector can go through a 10-year bull cycle, and no stock can go through a 10-year bull cycle, right? There will
Correct.
be journeys, and we have to kind of rotate our capital to give the best optimum result to our investors.
Absolutely. So now, learning from your mistakes, what you started doing was winners trim over valuation.
Yes.
then you did laggards, double or quit, and exclusion mindfulness. So if you can just dwell upon these three aspects.
Sure. So I think 2, 3 things that we did, when we started, when I took over the fund last year, is first move towards mid cap, where by design there's slightly higher growth as compared to large cap. So mid cap IT will grow at a faster pace than the large cap IT. Mid cap auto or ANC will grow at a faster pace than the larger auto OEMs as such. So we did that one round of change, and hence if you look at the mix of the fund today, we are closer to 40% mid cap, small cap, and 60% large cap, which was almost 85% large cap and 15% mid and small cap. So that is the first big change that we did. The second is that any company which has laggard, and most of the time you would see that a particular stock which is a laggard, it's primarily due to earnings growth, nothing else. Otherwise, the stock would definitely move up, right? If there's great earnings growth, why the stock won't move up?
Correct.
So wherever there is earnings issues, or wherever we believe the next 2, 3 years there is not great earnings growth visibility that we have in the stock, we will move out of that name, right, into another name.
Or you may just increase the exposure if you think that the earnings growth is likely to
come back. Either ways, right? So we did that exercise in a meaningful fashion. And the third is, look at major themes which are available today. So be a participant in most of the themes. Like for example, we bought Zomato right at the bottom, right? Because we could clearly see profitability side coming through for some of these names, right? And we could clearly see that growth coming back in some of these, startup names as such, right? So again, being extremely bold, something what we did in the mid cap fund, right? Ramdeji always keeps saying to us that you should have a foresight to see, how a company is going to do in the next 2 to 3 years, and then have the courage to buy and patience to hold, right? So if you have these three things, right, which is exactly what we did in the mid cap fund, trying to replicate here, and that has now started to bear some fruits, right? So some of the mid cap names that we bought, which are extremely high on quality, high on growth, we have dialed up the growth factor for the portfolio. Our portfolio growth used to be in the range of 18 to 20%. Now we are closer to 23 to 25%. So we are dialing up the growth every quarter after quarter, ensuring that there is no significant risk on quality of the portfolio, not compromising at all on the quality of the portfolio. And hopefully, once that growth really shapes out in the way we thought about it, it is reflected in the stock price, which gives you higher alpha.
So now, your revised investment philosophy seems to be investment philosophy of QGLP, of course, continues. Then investment universe consisting but not restricted to opportunity from Nifty 500, current holding sector leaders across market caps,
Right.
Investment framework winner category winners, and portfolio orientation economic recovery play, and finally skin in the game.
Absolutely.
So this is a new philosophy, or this is a evolving philosophy practically in all your schemes which you manage?
No, I think it's pretty much the philosophy that you just called out for. I think we continue to evolve as an organization. If we do mistakes, we will very quickly rectify them. We're not going to take a lot of time. For example, if a particular stock that we buy, if that stock goes down by more than 20% in terms of our underperformance to the index, we will restrict from buying any further allocation to that particular name. We will go and revisit that name. If that stock makes a lot of sense, we will still go and buy it. But if it is underperforming our index by more than 20%, there's something that we've got it wrong so far. So we will go and revisit that, and we will restrict buying that name at least for the near term. So I think some of these smaller measures that we have internally kind of institutionalized, I think has really helped us to, improve the performance of the portfolio, and not, being with the losers over the longer period of time, right? It's both sides, right? You have to play on both sides.
Correct. Now, when you started in 2014, the number of schemes into the Flexicap space was much lower. Now, currently, I think there are almost 33 odd schemes in the Flexicap. I think earlier it was about 14 or 15 schemes only. So the competition has also increased. But now, after putting in this new and revised framework, learning from your mistakes, etc., all of a sudden I can see in the last 6 months you have bounced back to being number 2 or number 3 in terms of point-to-point returns also. Now, does that competition and the number of schemes in that space, is that a concern, or is that how do you because so many schemes to beat because the mutual fund industry runs on quarter in terms of performances, and how you gauge the others. It's like a Friday to Friday for movies in the theater.
So Sunil, our report card is published every day, right? We give an exam every day. Our
Absolutely.
report card is published every day, right? I think competition is going to be there, across the board, right? I think, it's also there for a mid-cap fund, is also there for Flexicap, and for most of the other funds that are firm managers, I think we have competition. I don't think we get perturbed about competition at all. We don't lose our sleep over competition. I think what we really need to focus is ensuring that whatever is the process, we continue to follow that process, continue to focus on high growth, high quality names. I think till that time you are able to do that on a sustainable basis, you're extremely good. Second is, I think you have to catch some of these trends ahead of the curve, right? You don't have to wait for the stock to start moving and then, get into the action mode. We generally look at buying stocks, before the trend has to really start. That's what we generally like to do, because that is where you start making disproportionate returns. We started investing into EV companies, 2.5 years back, just after COVID, because we could clearly see this is a 5-7 year trend. It is
Correct.
now accelerated, but we already identified companies 2.5 years back which are going to be an EV beneficiary, whether it is on the IT side or whether it is on actually on the auto anchor or the auto OEM side. So some of these things, when you identify earlier, be ahead in the curve, buy the stock when the world wants to sell. You have to buy during the crisis time. I think once you do some of these things right on a disciplined basis, I think the outcome can never be wrong for you.
So right now, the 6 month, you can see that you're bouncing back slowly and steadily. You're number two or number three out of the 33 schemes. On 1 year basis, you're still at 20 or 22 in terms of the ranking. Now, how sustainable you have to perform for you to be in the top quartile?
So I just did that
And now in the
exercise of,
current macro situation, the what we discussed and the geopolitical situation, because there will be stumbling blocks on the way also.
we just did that exercise a week back, and we realized that we have to still have about 17-18% more to go before we go to first quartile across durations.
Correct.
We think it's about 18 months to 24 months we should be able to do that.
Now, I'm going to show this data to the viewers.
Sure.
Consistent alpha generator since inception, in spite of the fact that in the next 2018 to 2022, the performance lagged quite a bit. But in spite of that, if you see this data on a year-on-year basis, or from 2014 to 2015, 2014 to 16, 14 to 22, 14 to 23. So for 1, 2, 3, 4, 8 years and now 9.5 years, practically everywhere you've beaten the benchmark, which is your Nifty 500, I think.
Yes.
Of course, the alpha has come down from say 33% to maybe 2.25%, but consistently you managed to deliver alpha over the benchmark. So your thoughts on that? In
See,
spite of that underperformance for those 2-3 years.
I think whatever we benefited is because of the past 14 to 17, we had a massive run, right? And I
Correct.
think we've kind of lost out on some of that. We're trying to just regain that to ensure that over the longer term also we go back to the top quartile range. And as you rightly said, right, I think we are in middle of a bit of a macro storm right now. There are too many moving parts in the macro, which wasn't the case in the last 2-3 years, right? It's virtually like a bit of a ride that we all enjoyed on the mid cap and the small cap side, including
Correct.
large cap as well. Now I think it is coming to a point where some of the macro headwinds are visible, right? And hence it becomes extremely important that we go through this journey of we have to get another 17-18% over the next 12 to 18 months or 18 to 24 months without ensuring that we have any accident, right? Because of macro factors. You
Correct.
don't want to be in a situation where you could clearly see there are macro factors about to impact the markets in the next 6 to 9 months, and yet we get impacted, right? So after knowing, we should be very, very clear that we have to avoid this. At the same time, we have to
How do you
ensure that we
avoid
do
that?
very
Because the writing is on the wall. You are seeing this, in front of you, how it is panning out. How will you avoid these stumbling blocks, which are, or the headwinds which are there for it?
So I think one important way to avoid is move out of cyclical sectors, right? Anything which is cyclical in nature, right? Move out of that.
So you're
Second, I think
mindful of that and you're making necessary changes to your
absolutely,
portfolio.
every day when we move, we make any decision, we think about drawdowns more now. So
Right.
every day we think about drawdowns. Okay, if you're buying this stock, what can be the drawdown that you can see today, right?
Correct.
So I think that has always been a philosophy whenever we look at any
So
stock,
that's
that
an
what can be.
ongoing exercise which you're
It's
doing
an
on your
ongoing exercise.
portfolio.
But right now, what our focus has been that can you get to businesses which are domestic driven, where the growth rates are more sustainable, valuations are more reasonable, and at the end of the day, you also have to ensure yet that, you don't meet with any accidents, right? Which are, again,
Correct.
and most of the accidents typically you see in cyclical sectors, right? For example, you get into a metal stock, right? Something goes wrong in the metal stock, right? From a metals prices standpoint, right? Or you get into a banking stock or an NBFC stock where anything goes wrong in the asset quality side in because of these global macro issues, which obviously spill over the world over a period of time, then you can get disproportionately hurt. So we've been very, very mindful of that fact. We are going towards companies where the balance sheet are extremely strong. They have cash on balance sheet, return ratios are very superior, valuations are reasonable, and even if the growth rate is 25%, we are absolutely happy with it. So 20 to 25% growth rate, stable, cash flows, strong balance sheet, strong management. We believe that's a recipe that we can't go to 100% cash as a mutual fund house, right?
Yeah,
So
yeah.
we have to remain invested, but at this point in time, the idea is to reduce your risk of the portfolio, move out of small caps, move more towards large caps, and ensure that there's capital protection.
So are you, as a fund manager, not as a fund house, but as a fund manager, are you keen on taking cash calls frequently at such points in time?
We generally don't
Or
take
does
cash
your
calls.
fund house actually allow you to do that?
No, first of all, we don't take cash calls. The cash call is typically taken where you take a market view. You don't take a market view. We definitely know that there
So
are
you left it
headwinds.
at the mutual fund distributor level or the investor level in terms of asset
No, so
allocation?
for example, if we get a stock, we will definitely buy it. We will not keep cash. In
Right.
absence of no idea that we could clearly figure out today, right? Then we will end up with having slightly higher cash. If we believe that, in mid cap space or small cap space or within large cap space, valuations are extremely unreasonable, very tough to get an idea which follows under a QGLP framework, not compromising on quality, we will end up with slightly higher cash.
Right. So currently your portfolio is almost 59% in large cap, 27% in mid cap, and about 8% in small caps. Marginally higher than what they were in August 2023. So you actually increased your mid cap and a small cap by
Right.
some margin,
Right.
and reduced a bit from the large cap. We would have assumed the other way around. What
We
prompted you to do this?
that will so the other way around is actually going to plan out in the next few months till the
Next few
month end.
months. So
Yeah,
you will be more heavyweight on large cap rather than in the mid cap
that's
and the
correct.
small.
We will definitely move more towards large cap rather than mid caps,
And on
for
the
sure.
sector side also, if you see, your sector allocation is basically finance is 20%, banks is 12%, consumption is 21%, and IT is 16%, auto and auto component is 10%. So your
Right.
justification for this, especially the IT, in
See,
the
I think
rising interest rate scenario?
See, I think again on the IT side, while the interest rate definitely tends to move up, you have a significant artificial intelligence wave coming through in terms of AI spend that every organization has to do in US, Europe, or India. Right? It's a buzzword in any corporate board meeting today. We believe Indian IT will become one of the biggest beneficiaries of that cycle, and we believe within IT today, there are pockets where there is growth, and we believe that this year is a year where the growth will be the lowest, and we will have a bottoming out of the growth this year, and next year you will start seeing growth coming back for most of the IT names. We believe the valuation in some of the IT names, and if you take into consideration the quality of the balance sheet that IT company have today with massive amount of cash, we believe they are best hiding place for us. The second important thing is that if you look at what is happening to dollar index, right, what is going to happen to rupee, right, in that entire macro scenario that we talked about, IT will tend to stand out far better as compared to some of the other sectors. So our view is that we want to play this AI wave. We believe that spending has to come back next year.
So it's a
uh,
contrarian view currently, which will pan out over a few months or a few
Absolutely,
quarters down the line.
over the next few months, yes, hopefully, and into
So now
next year
your
as well.
final thoughts on how would you bring your flagship scheme? This used to be a flagship scheme. Motilal Oswal was known
Right.
for its most 35, which was the earlier name for the Flexicap scheme. How will you ensure that you are back in the reckoning in the Flexicap space? So
so
your
i
final
think
concluding thoughts on that.
I think we continue to focus on bottoms up idea, high growth, high quality companies. We are extremely nimble. We don't want to get into a zone where we will now hold a stock for eternity. We will be very, very smart and quick sellers. We will take off money from the
Market
table.
cycles and business cycles are becoming
Have
short.
also become shorter, right? So they have also become shorter, and we have to accept that fact. In fact, there are a lot of times where you buy a particular stock, the stock goes up by 40-50% in just months, right?
Wow.
Which is typically our horizon to make 25-30% return over the next 1 year. They're actually going to go up 50% in few months. And we have to take course correction. If we don't take course correction, we will end up underperforming, right? So
Correct.
we have to be very mindful of that. And that's what we are up to.
Thank you. Thank you so much, Niket. It's really always a pleasure talking to you. And I love to talk to you about the global macros also, along with the Indian macros. And finally, of course, your fund performances, which are really doing well. And all the best to Motilal Oswal and your team for a stupendous performance going forward for Flexicap schemes, where most of the investors were getting a little impatient, but now I'm seeing that you're coming back on track, and hopefully this journey will continue for the investors as well. Thank you.
Thank you so much, Sunil, for your time. Thanks for having me here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.